Welcome back. We have spent the last few sessions talking about the difficulty of entering the market. We discussed the fear of the crash. We discussed the paralysis of the falling knife. And we discussed the anxiety of FOMO. But today, let's assume you did it. You overcame your fear. You bought the dip. You executed the trade. And now, for the first time in a long time, you see something beautiful on your screen. You see green, the numbers are positive. You are making money. This should be a moment of triumph. But for most traders and investors, this is actually the moment of maximum anxiety. Suddenly, a new voice whispers in your ear. Take the money. Lock it in. What if it turns back down? You finally have a win. Don't let the market take it back. Your heart beats faster. You watch every tick of the price. If it drops even 1%, you panic. So, to relieve that anxiety, to make the uncomfortable feeling go away, you click sell. You take a 5% profit. You feel relief. You tell yourself, profit is profit. You can't go broke taking a profit. Then, you watch in horror as the stock proceeds to rally another 20%, 50% or 100% without you. You captured the crumbs, but you missed the feast. This is the psychology of taking profits too early. And in academic finance, this is known as the disposition effect. The disposition effect is the tendency for investors to sell assets that have increased in value while keeping assets that have dropped in value. We cut our flowers and we water our weeds. Why do we do this? Why is it so hard to let a winner run? It comes down to how our brains process paper profits versus realized profits. When a trade is open and in the green, your brain views that profit as fragile. It feels like maybe money. It doesn't feel like yours yet. The possibility that this money could vanish triggers the same loss aversion we talked about in the first chapter. Losing $1,000 of profit feels just as bad as losing $1,000 of your principal. So, your brain urges you to realize the gain. By selling, you transform that fragile, uncertain number on the screen into a solid, certain number in your bank account. You sell not to make money, but to purchase emotional relief. You are paying the market, your potential future upside in exchange for immediate comfort. This is a disastrous strategy for building wealth. Think about the mathematics. If you are the type of investor who holds losing trades for a long time, hoping they come back, but sells winning trades immediately to feel safe, you have created a negative asymmetry. If your average loss is 15%, but your average win is only 5% because you sell too early, you need to be right 80% of the time just to break even. Nobody is right 80% of the time, not even the best hedge funds in the world. To survive in the markets, you need to let your winners run. You need one big win to pay for 5 small losses. So how do we fix this? How do we rewire our brains to hold on to a winning trade? When every fiber of our being wants to sell, we need to change our relationship with the break-even point. The moment you enter a trade, you are stressed because your capital is at risk. The moment the price moves up, you have an opportunity to remove that risk. Instead of selling the asset to remove the risk, simply move your stop loss to your entry price. Now you have a risk-free trade. If the market reverses, you lose nothing except commissions. If the market rallies, you participate. Once you move your stop to break even, you must tell yourself, this money is no longer my concern. I have protected my downside. Now I will let the market decide how much it wants to give me. This removes the anxiety. You don't need to lock in the win to be safe. You are already safe because of your stop loss. Another psychological hack is the partial take profit. If the urge to sell is overwhelming, if you cannot sleep because you are afraid of losing your gains, then sell half. By selling half, you satisfy your primitive brain's need for safety. You locked in some money. You proved you were right. You got your dopamine hit, but you keep the other half. You satisfy your strategic brain's need for wealth accumulation. If the price keeps going up, you are happy because you still have shares. If the price goes down, you are happy because you sold half at the top. The goal of trading psychology is not to eliminate emotions. That is impossible. The goal is to negotiate with them. We must stop treating our winners like hostages that we need to release as soon as possible. We must treat them like employees. If you had an employee who was performing exceptionally well, making you money every day, would you fire them? No. You would fire the employee who is losing you money. Yet in the stock market, we fire our best employees, the winners, and we keep the lazy, destructive ones, the losers. Change your mindset. When a stock is going up, it is doing its job. Let it work. Give it room to breathe. Do not suffocate it with your anxiety. Learning to sit on your hands when you are making money is the hardest skill in finance. It requires doing absolutely nothing when you desperately want to do something. But remember, big money is not made in the buying or the selling. It is made in the waiting. In the next session, we will explore the other side of this coin. What happens when the stock has gone up too much? What happens when we refuse to sell because we want more? That is the story of greed, why we fail to sell at the top.